All right, and now we have our member instructor today, Jason Jones. He is a retired tech entrepreneur. He grew 5 startups in the enterprise software space over the course of 20 years. He founded and sold Invoiceware International. It grew from 1 to 10 countries across Latin America while he was working in it. And he has expertise in both economics and tech, along with a passion for Bitcoin. And so he is here to talk to us about what the heck is Bitcoin and why should we care? And with that, I'm going to turn this over to Jason.
Okay, great. Well, then let's jump in. I'll cover, I've got a lot of material to cover. I'll try to just go through it fairly smoothly. Of course, feel free to interrupt with questions as we move forward. There won't be too much technology. I'm going to just focus on the high level basics, you know, like what is Bitcoin? And again, why should we care? So rather than bury the lead, as journalists say, let's just answer those 2 questions right off the bat. So what is Bitcoin? Bitcoin is money. It is savings money. Right now, it's not so much the kind of money that you might have in your checking account that you might use and spend every day to buy a coffee at Starbucks or that kind of thing. It's more savings money, the kind of money that you would like, almost like gold. It's kind of like the money that you would want to preserve its value for the future. It's the kind of value that you want to transport over time. You know, as adoption grows in the future, it certainly is highly divisible. You might hear people say that there's only 21 million Bitcoins that'll ever be created. And that's true. But each Bitcoin can be divided into 100 million little pieces, Bitcoin pennies called Satoshis. So you could use Bitcoin to buy your coffee or even things that are smaller than that. But for now, it's mostly considered to be a store of value. And the way I like to, you know, my elevator pitch to people is I say, just imagine $1 trillion worth of gold sitting in the open in Central Park, protected only by an impenetrable, invisible dome of math and electricity. That's Bitcoin. It's scarce, physically scarce, not just digitally scarce, not just password protected. It is physically scarce through the energy that's used to mine it. You can move it anywhere in the world in 10 minutes. And most important of all, it is incorruptible. It is not controlled by humans. It's controlled by millions of tiny computers running all over the world that anyone could start up and run today. And all those computers cooperate together through a process called consensus or truth building. That's the high level, you know, the high level on what Bitcoin is. Why should we care? Well, we should care because money matters. Money is the foundation for cooperation in society. You know, people work hard and they want to be able to trade their labor for the other things that they need. But in order to do that, they have to have a medium of exchange. They need to have a money that they can trust and that they know will work not only today, but in the future as well. That allows people to plan for the future. It's not just like in Argentina, for example. I've talked to people who, you know, they would get paid on a Friday and they would spend their entire check at lunchtime because by dinner time, their check would be worth less. So in that kind of environment, in that kind of society, it's all about now, now, now. You have to spend your money now, 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 because it will be worth less a few hours later. And that's not good for society. We want people to be able to plan, to invest, to prepare and share for the future. Also, businesses have to allocate capital. They have to make all kinds of decisions about how many crops should I plant, what kind of manufacturing should I deploy. And in order to make those decisions, they need a stable ruler. You know, it's like, imagine if you tried to cut some cloth and one day an inch was this big and the next day an inch was that big. You know, by having a stable money, you have a unit of account that can help businesses allocate resources more effectively. Beyond that, though, you know, the kind of money that we've used throughout history, the so-called fiat money, you know, has been prone to inflation, and that hurts. That hurts the poor. You know, the cab driver, the waitress. You know, people who are low income wage earners. You know, they they don't, when they're starting out, they can't afford to buy a house. They can't afford to invest in stocks. They typically save in dollars and or in the fiat currency. And if that value is shrinking, you're really taxing and hurting it's a very regressive type of hidden tax. And ultimately, this has been seen time and time again, whether it's limestone if used as money, whether it's glass beads that are used as money, whether it's silver that might have been used as money, or gold that's been used as money. The hardest money, the most scarce money, always wins in the end. So in some sense, you could say Bitcoin is inevitable. What I'd like to do today, what I plan for today, is to talk, again, zoom out and come in, talk a little bit about, what is money? Why do we have it? What makes a good money? If we were starting over again, how would we design a good money? This notion of like, what's the game theory around money? Like, what kind of behaviors does the choice of money induce in society? And with that background, we can talk some more about the particulars of Bitcoin, the relationship between Bitcoin adoption and the price. We can distinguish Bitcoin from the other so-called cryptocurrencies that are out there, and perhaps some, investment or some conventional wisdom or some best practices type of thing. I've got one slide on the technology, mostly to make it clear around how Bitcoin is secured. But I won't go too much into that. And then some best practices on how you might want to get started if you're interested. Okay, so money. Why do we have money? Pretty much any culture anywhere in the world has stumbled upon this idea of money. Because basically, I may be good at making apples and you may be good at making shoes. And so by me specializing in making apples and you specializing in making shoes, we can barter and trade those things, and there'll be more products in society than if we try to do everything ourselves. But of course, me bartering, trading shoes, and you bartering and trading apples, I mean, it's not efficient, right? Maybe I don't want any shoes. Maybe you don't want any of my apples. So if we have this medium of exchange, if we have this money, this thing that we all agree to accept in the middle, I can trade my apples for money, and I know I can use that money to buy pretty much anything. So that basically promotes the cooperation in society. We all agree to accept this money, and then we can all specialize and be more efficient in creating more wealth, more good things for everyone. And so then once you have that baseline, once you have that medium of exchange, the next piece is savings. Now we come into store of value, because if I can work hard and grow more apples and I can get more money, well, then I can save some of that money and I can maybe use it in the future, right? And that's where this notion of store of value comes into place. And so as I contemplate, what do I do with my money? You have to think, if that money isn't accepted anymore, like for example, here's a guess what? Here is $100 trillion right here. I'm holding it, $100 trillion from Zimbabwe. This is actually real money that they printed, but it's not in use anymore. So if I had saved that money, well, then I would have lost it because it wouldn't be used in the future. Similarly, if the amount of money I save now is worth less in the future, meaning inflation or whatever, then it didn't hold its value, and I'd be better off spending my money now than if I saved it. And so a hard money, a strong money, a good store of value, something like gold, for example, holds well over time. You can see in the graphic here, an ounce of gold in the Roman times would buy you a nice toga, and an ounce of gold today will still get you a nice suit. So that's why we have money. Now, what makes a good money? What are some of the good properties of a good money? Well, we talked already about acceptance, and acceptance is absolutely vital, because if you don't have it broadly accepted, then you don't have a medium of exchange, and you're not that far off from just barter. On the other hand, acceptance, while necessary, is not sufficient. You need both acceptance and scarcity, because scarcity is what gives a money its hardness. That's what helps it preserve its value over time. And so the foundation of a good money is acceptance and scarcity. But there are other properties that also make for a good money. For example, if you can move it from place to place, you don't want to walk around with a bunch of gold bars in your pocket. That's kind of hard. And it's certainly hard. It should be divisible. It's hard to buy a Starbucks coffee with like shaving off 3 grains of gold, right? And it should be durable. You don't want, you don't want to leave your money in your pants pocket and it goes in the laundry machine and then all of a sudden it's been, bled dry and it's no longer usable. So these are some of the main properties of a sound money. The most important being acceptance and scarcity, and we'll see how that reflects on value in just a moment.
The basic question I have about money: can anybody out of 8 billion people on this planet create money? I mean, that's why I have a difficult time understanding this concept of Bitcoin as money, because then anybody can create anything and call it money, but it doesn't have the backing of fiat currencies or anything else. So, that's my question, Jason. If you can clarify.
Yes, I will go through that, and I'm going to go through some examples of different things that have been considered money over time, so that we can compare and contrast. Yes, you can say anything is money, but the question is, what is it, a good money or not? Now, if I were to invent my Zimbabwe money right now, would you sell me your car for this Zimbabwe money? Well, probably not, right? So that's why you need to have money that's accepted. And then you need to have money that's scarce, because if money isn't scarce, then people are going to spend their time manufacturing money instead of manufacturing the goods that you want to trade with that money. And so, yes, anybody can create any kind of crypto coin easily, but is it going to be accepted? And is it going to be scarce? And does it have these other properties? So let's look at gold versus cigarettes, right? Pretty much everyone would agree that gold is valuable. It's very broadly accepted. It's highly scarce. There's only out of all the gold in the world today, the amount of gold increases by 1.5% per year. That they call that the inflow compared to the stock to flow ratio, the inflow of new gold compared to the amount of gold that's here already. It's growing by about 1.5% a year. That's a pretty low number compared to paper, or compared to silver, or compared to copper, or other types of raw materials. Cigarettes, on the other hand, they're not really scarce at all, except in prisons. So if you were in prison, they use cigarettes as a means of exchange, as a point of money, but it's not used more broadly elsewhere. That's one example of scarcity being too scarce. Gold would be too scarce in a prison, but cigarettes would be sufficiently scarce where you could actually use it as money. If you were to consider now gold or dollars, so the key thing about gold and dollars, now dollars are broadly accepted. They're accepted everywhere, pretty much everywhere in the world, right? Now, why is that? I mean, what is the intrinsic value of a dollar? I mean, after all, it's just a piece of paper, right? Well, the intrinsic value of a dollar comes from law. It is fiat, right? We have the government of the United States, we have the military of the United States that has commanded and enforced that this paper currency, this dollar, will be accepted by everyone. And if people don't like that, well, they don't really have a choice. All they can do is sort of grumble. Maybe they can raise their prices, or maybe they can try to barter and trade. I don't really want to use dollars. Let's just go back to barter. Or maybe I'll take your dollars and I'll go buy some gold. But at least for your spending money, the acceptance is very broad, because it's a fiat. It's by law. The scarcity, on the other hand, is a big problem. It's problematic on pretty much any fiat currency, because it's very easy to print more money. In fact, you don't even need to print it anymore. Imagine that you had a bank account and you could just hit the edit button. You have $1,000 in your banking account. You just hit the edit button and then you add 6 more zeros and you hit enter. Poof. Now you've got, $1 million. You can actually do that. If there is a mainframe at the Federal Reserve that is used to control how much money is in the society, and that's all they have to really do. So the amount of dollars that are in the system is controlled by the central banks, is controlled by the political system, and there's no real world physical constraint on the money supply in any fiat system. So if you just look at the game theory around that, it's awful tempting. It's awful tempting to just increase the money supply, and then no one will really know at first. And you can just kind of extract value. You can extract value out of the country, out of the system, like a tax, without anybody really even knowing. And so the temptation to do that is essentially irresistible, especially when some sort of emergency happens, like a war or a pandemic or some other good cause. And so all fiat currencies tend to inflate and hyperinflate and die over time. It's really just a fact of history. And so now let's consider gold versus Bitcoin. Well, for now, gold is more broadly accepted than Bitcoin, but Bitcoin is gaining fast. If you look at the growth in the number of accounts and the number of people who are using Bitcoin, it's rising faster than the growth of the internet in the early 1990s. So the adoption is happening. Gold is very scarce. It's got a stock to flow ratio of 1.5% and 1.5% inflation, you might say, per year. Bitcoin matches that now, and every 4 years decreases. So basically, within about almost 90% of all the Bitcoin that will ever exist, it has already been mined, and it will cap out at 21 million Bitcoin, and there will never, ever, ever be any more. Nobody can control that, because no group of humans are able to change or inflate or create more Bitcoin. They don't control it. It is decentralized in millions of individual computers controlled by millions of regular people that are coming into the network more and more over time. And so it's just, you can't censor it, you can't inflate it, and it is physically scarce because you have to spend money to mine it. You have to burn electricity to create it. And so that ties the cyber world to the physical world. So you might ask, I'm sure people are probably thinking, if Bitcoin's so great, then why has its value dropped? Why did it used to be $69,000 and today it's only $20,000? How can you consider that to be a good store of value? And the answer really goes back to adoption. Again, adoption and scarcity are a virtuous cycle that feed off of each other, right? And so if you think about, the technology adoption curve, right? You kind of start at, 0% when no one's using anything, and then you grow up the adoption curve until you get to 100% and everybody's using it now. This follows a well-established pattern that we've seen in other technologies. It's not unique, right? It happened with microwaves. It happened with televisions, it happened with telephones, it happened with the internet, and it happened more recently with tablets and smartphones. There's typically a beginning stage where you have your kind of innovators who play around with it, then you get your early adopters, then you start to get some critical mass and you have your early majority until you have your laggards and everybody else that starts to use it. And so when you look at the adoption of Bitcoin in the world today, look at it by country, you can see that, it's 20% at the high end and about, 3 to 5% at the low end. Now, one thing that's interesting is to look at the countries that are adopting it more versus the ones that haven't yet caught on. And it's no surprise, if you think about it, that it's emerging markets that are the most that are the furthest along in terms of adoption. It's kind of like what happened with cell phones, right? In Africa, the cell phone growth went super fast because there was no legacy infrastructure. There was no conventional telephone systems there. So it was really easy. You just started using cell phones. Well, these countries have experienced hyperinflation. I mean, Turkey's inflation rate is like 200%. Venezuela's 5,000%. Argentina is the example I used before, where people would go rush out at lunchtime to spend their paycheck. So it's not surprising that these countries that have experienced hyperinflation are the ones that are most aggressively adopting Bitcoin as a store of value, because they know that it's immune from the government corruption. But even in the United States, I mean, 5% is nothing to sneeze at. If you look at this sort of like crossing the chasm of like, is something going to make it? Usually, once it gets above 5%, historically, it winds, you wind up making it. If you take a look, at the adoption curve, that's kind of where we are. That's kind of where we are today. So imagine, if Bitcoin's at 20,000 or ranging between 20,000 and 60,000, and we're at a, 5 to 10% adoption range here, what do you think might happen to the price of Bitcoin as adoption grows from 5% to 10% to 50% or more? Now, you may look at that, you may think about that from an investment perspective or dollars or whatever, but actually a Bitcoin person would say, you really shouldn't think about it that way. You should think about it as, 1 Bitcoin is always 1 Bitcoin. 1 ounce of gold is always 1 ounce of gold. It doesn't matter really how much paper dollars it might be. It's the unit of account that will ultimately wind up being used in the future. So here's another slide on the adoption piece, and you can kind of see what I was talking about earlier. Here's the growth curve from 0 to 100% of microwaves. The microwave ovens started in the 1970s, 1980s, they grew up to 80%. Now pretty much everyone has a microwave. You can see the same thing with the tablets. The iPad came on the scene around 2010. Now the tablets are about 60% already. And when you take a look at the internet since the 1990s now today, it's grown from 5, 10% all the way up to 85%. That's happened within the course of 10 to 20 years. And if you drill in here, you can kind of see, well, from 1990 to the year 2000, this is the growth of the internet, and at the bottom, you can see from 2014 to 2024, this is the growth of the Bitcoin users. And so the growth of this technology, it is happening. It's happening along a well-established adoption curve that we've seen in other advances in technology. And so if you step back and think about it, it's not unreasonable to think that this just might be another one of those things. So I often tell people, well, I got some gray hair. Do you remember when email addresses first started showing up on business cards? I remember when I first received, I was like, wow, that's interesting. You got your email address in your business card. Oh, that's weird. Usually it was just a phone number. Do you remember when websites started when television ads started putting the website at the end of the television ad, or you started seeing www.whatever.com on buses, or even more recently, within the last 2 years, those QR codes, those little square codes with all the dots in there, those QR codes, those have been popping up more and more recently, right? I mean, these QR codes have really started to become adopted more and more broadly in society. So this notion of change happening and adoption happening, it is a real thing, and it does flow according to a well-established pattern. So now let's talk a little bit about corruption and money. Now I use this word corruption, but I don't mean it necessarily in a bad way. I just mean it in terms of the incentives, like it's just kind of like the game theory. If I had the ability to just print more money, if it's almost like Lord of the Rings, you get the ring and it turns you into my precious, it's my ring. It's if you have the ability to just print money, it's awfully tempting, and it's very, very hard to resist it. And so, at the beginning, if you look at the money supply, here's the US money supply from 1960 to 2021, they have it pretty much under control. They're inflating a little bit, and they're getting away with it, because printing money is free. No one really notices it first. But then some emergency happens, some conflict happens, some pandemic happens, whatever, and they just print a bunch more money. And then it takes a while for the consequences to be felt throughout society. I think if you look today in the United States, within the last 3 years, 80% of the money supply of the M2 money supply that's in circulation right now has been printed within the last 3 years. So this is starting to get serious. It's an exponential curve, and that never ends well. Whereas if you contrast that with Bitcoin, Bitcoin is hard capped at 21 million. There'll never be any more. There'll never be any more than 21 quadrillion bits of Bitcoin that are wrapped up into a single coin. There are 21 million of them, and humans can't increase it. So now you know, if the acceptance gets up there, then the scarcity is baked in through math. And if you take a look, I mean, here's the world. You know, this is what, 2 years ago old now. You know, Venezuela 5,000%, Lebanon 224%, Turkey 70% inflation, right? And I already showed you about Zimbabwe. $200, you can get $100 trillion. Notice here it says no longer legal tender. Gee, I wonder why that happened. It happened because of this, because that curve makes this kind of money. So do you think it can't happen here? Well, not so sure, right? I mean, just what I often do, there's been a Business Insider study of 775 fiat currencies. And they calculated that the average life expectancy of a fiat currency, a paper-based currency, is 27 years. Now, the US has been around for over 200 years, but we really haven't had a fiat currency all that time. The paper money was backed by gold. It wasn't until 1971 that the US went off the gold standard. So we've been a pure fiat paper-based currency for about 50 years. So we're beating that average, instead of 27 years, we're about 50 years so far. But go ahead and go on Amazon. Take a look at your order history and look at something that you bought a year ago or 2 years ago. And now take a look at it today and see what the price would be today. These sandals cost me $60 in 2021. Now they're almost $80. Okay. Talk to a young person, ask them how much it costs to rent an apartment, right? The 1 year increase in a 1-bedroom and a 2-bedroom apartment, it's gone up by 25% and 26% respectively. So inflation is not a number, it's a vector. There's the inflation for rent, there's the inflation for food, there's the inflation for gas, there's an inflation for clothes. And so, you have to kind of think about it that way and realize that our economy is in fact being affected by inflation, and it's getting serious. The other thing I would say is when you look at debt, again, thinking it can't happen here. The way that the money printing is introduced into the economy is in the form of debt. The Treasury Department sells a bond and the Federal Reserve buys it. Okay. Right now, about 30% of all of the US government debt is owned by the Federal Reserve. That means one hand prints, one hand offers debt, the other hand prints money and buys it. Okay. And so when that happens, like, how are you gonna pay off this debt? Like right now, if you look at the US economy, we're at 137% of GDP. So that means if we make $100 a year, like imagine you get your paycheck at the end of the month, and then you get your credit card statement. Your paycheck's $100, your credit card statement's $137, right? We owe 137% of what we make already. And so, when you look at how are you going to pay that off, how do they do it? Are they going to tax their way to pay that off? Are they going to grow their way to pay that off? It's possible, but more common than not is they inflate their way to pay that cost. And here in this IMF working paper, they kind of say they're upfront about it. They call it financial repression. We can basically print a bunch of money, and that'll suck out all the savings and value from the people. They won't even know it. They'll just complain about higher prices, and then we can pay off this debt with cheaper dollars. That's the way it's been done historically many times throughout time. So it doesn't have to be this way. Bitcoin people say Bitcoin fixes that, right? Number one, the temptation to corruption goes away because it's controlled by a network of computers run by individual people all throughout the world. So that means it removes the human ability to create or manipulate money. It's just the ability to create money is just too much power to entrust to anybody. The United States has division of power because we say, hey, look, power corrupts and absolute power corrupts Absolutely. It's no one's fault. It's just the way we are. It's just the game theory of it all. So the best thing you can do is just split the power, divide the power, decentralize the power, so nobody can have too much of it. And Bitcoin does that. It removes people from the money printing process. The other thing, as I mentioned before, Bitcoin is physically scarce, right? It's not just digitally scarce, it's physically scarce because you have to use physical resources, electricity, in order to mine it. Again, I won't get too technical, but the way it works is you've got these millions of computers. They all run a separate copy of the database. I say there's this much money. You say there's that much money. He says there's that much money. She says there's that much money, and who spent it. And yet we all agree. We all agree on a single version of the truth. And how do we agree on a single version of the truth? Well, we all individually run a computer program to try to solve a math problem, and whoever solves it first wins. We all agree, whoever solves this math problem first wins. And then we all agree on that. So that's called the consensus algorithm. That's called the truth-making process. That's how you take a decentralized network and you get a single version of the truth out of it. So by using physical resources, by spending money in the real world on electricity, it imposes a physical cost on this truth-making process, thus tying cyber reality to physical reality. And that's why Bitcoin is not just digitally scarce, it's physically scarce. It's more scarce than gold. Now, the next thing you have to say is you have to talk about the environment, right? Because the minute people hear, oh, you're spending electricity, oh, that's not good, it's not green, it's wasteful. Well, wait a minute. How much energy do we spend on banks? How much energy do we spend on Christmas lights, right? And actually, I would argue, and Bitcoin people would argue, that Bitcoin is good for the environment. Bitcoin is actually the real Green New Deal. Because think about this. You can take there are vast amount of energy that just goes wasted every day in society. You know, there are in the oil industry, for example, you know, you're drilling oil out of the ground and you don't want those oil wells to explode. So there's the natural gas that's mixed up in there, and that natural gas gets burned and flamed out. They call it flaring. Well, you can capture that natural gas and now you can use it and mine with it to save that value. You're basically turning wasted electricity, wasted energy, you're turning that into like a digital battery. Bitcoin's kind of like a digital battery. It can store the value of that wasted energy in Bitcoin. And even in less remote locations, like for example, in the power grid, you know, the power grid, the infrastructure of a power grid is designed for the peak demand, right? That's like if you're in summer and it's 100 degrees and everyone turns their air conditioner on at 3 o'clock in the afternoon. Well, the power grid has to be built up to handle that peak, right? Even though it's really not used that much at other times of the day. And so power companies, utility companies now are like, wow, these Bitcoin people are great because now I can afford to build out my power grid and make it bigger, you know, and in those times when I don't have peak need from the rest of society, the Bitcoin people can come in and maintain an even demand. So that actually strengthens the power grid and allows for better, more resilient infrastructure in the energy space. And then finally, if you think about it, you know, what do they say? Necessity is the mother of invention. Well, if you talk to Bitcoin miners, all they can is like, I got to get lower energy. I got to get lower energy. I got to get lower energy costs. And so if there's a tremendous economic incentive for some Thomas Edison out there to figure out a way to get energy to make energy cheaper. You know, maybe that's a better solar panel. Maybe that's a, you know, better windmill. Maybe that's volcano energy. Maybe it's a 0-point module. Who knows? But if anybody can come up with any way to make electricity cheaper, there is a ready-made use case in Bitcoin that will be adopted immediately. So anyone who comes up with a better way to make electricity cheaper is going to be incredibly rewarded. And as I mentioned before, it's better for society. It promotes long-term thinking, which is good for society. It enables stable measuring stick for businesses. And it kind of forces governments to live within their means because they can't really just raise money through they have to raise money through direct tax, honest taxes, direct taxes, rather than through this dilution tax or this inflation tax that just saps the savings of people without anybody knowing. I'd like to say a quick word. I'm almost done here, so I appreciate your time. I'd like to say a quick word about the distinction between Bitcoin versus crypto, and especially for new people. I'm not going to say that there's never a use case for another cryptocurrency and it's only Bitcoin, but especially for new people, I would say that. Bitcoin has already garnered 20% acceptance in Turkey and these other countries. It's like if governments try to censor it, they're not going to. The emerging markets are going to overwhelm it. So Bitcoin has already come over the initial adoption hurdle. Its dominance is now 40 to 50% of the entire market. I mean, the bus has left the station, and it's Bitcoin. So even though there are other currencies like Litecoin, for example, is another cryptocurrency, and Litecoin is also tethered. Its scarcity is tethered to physical reality, but its adoption is just nowhere near that of Bitcoin. So it's much safer to go with Bitcoin rather than these other things. Now, these other coins, these so-called altcoins, like Solana or Ethereum or Luna or whatever, these coins are basically they range from outright scams to angel investing. They're really just businesses. It's another way for a business to raise money. They say, okay, instead of going to the stock market and issuing a bunch of shares and then getting people to give us money for those shares, and then they hope that the shares go up in value because the company does well, what they do is they say, hey, we're going to make this coin, and we're going to keep 20% of the coin for ourselves, okay? And then we're going to sell the rest of the coin. And then the people who buy that coin are going to hope that it goes up. That's a stock, that's a security, that's investing. That's not a store of value. That's not saving your money. That's speculation as opposed to store of value. So, ultimately, as I said before, whether it's glass beads, silver, seashells, or cigarettes, the hardest money always wins. Bitcoin is the hardest money. It's got the broadest acceptance. It's growing the fastest. It dominates 40 to 50% of the market. So it's your safest bet. Don't play in this other space, especially if you're new. You're not going to like it. Okay, quick thing about technology. I'm not going to go into all of this, but I'll just say a couple things. You might have heard the famous equation from Albert Einstein: E equals mc squared, right? Energy equals mass. Well, in cryptography, the equation is E times G equals P. Basically, your public key is equal to your private key times some standard number. Now, in the case of Bitcoin, that's a point on an elliptical curve, but basically the idea is you have this ginormously large prime number times another ginormously large prime number on a curve, and that's going to give you another ginormously large number that you can share with everyone. And there's a property of math called the discrete log problem, which means that it's very, very easy. If you know E, it's very, very easy to figure out P. All you do is E times G, boom, you got P. But if you know P and you don't know E, there ain't no way you're going to go back. It's a one-way math function, okay? And so basically, if you talk to the mathematicians, they would say there is no known algorithm to go back the other way. And that is essentially, that's the math that protects the gold in Central Park. These prime numbers, the number that is your private key, it's just a number. It's just a large, very large prime number. Well, that number is larger than the number of atoms in a billion galaxies. So there ain't no way you're going to be able to compute or brute force or guess what someone's private key is. And just to make it super clear around the security, the way I like to describe this notion of a blockchain, okay, is imagine a blockchain as a series of treasure chests, okay? They're linked together in a chain of treasure chests. And each treasure chest is clear. You can see how much money's inside. Anyone can see it. It's right there in Central Park. But there are two locks on that treasure chest. One of the locks is P, a public key. That serves as sort of like a mailbox address, so you know where to find it. But the other lock is E. It's the secret key. Okay. And so there are, because these treasure boxes are visible, the guy who invented Bitcoin, his name's Satoshi Nakamoto, nobody really knows who he is. He mined a bunch of Bitcoin in the early days. There's some treasure boxes out there on the public blockchain for anyone to see that have over 1 million Bitcoins inside. That's a lot of Bitcoin. 1 million, even at $20,000, 1 million times $20,000, that's a lot of money, okay? That's just sitting there. If you could figure out what E is, I mean, everybody knows what P is, that's public. If you could figure out what E is, boom, you've got yourself 1 million Bitcoin, but no one's figured it out. And believe me, people are trying. They're pounding on that invisible force field each and every day. I mean, when have you ever heard of a computer network that hasn't been hacked? Whether it's the DoD, whether it's Bank of America, pretty much whether it's Facebook, whether it's Amazon, all of these centralized systems have been hacked by somebody. But Bitcoin's got 1 million Bitcoins sitting in this publicly visible address, and no one's been able to crack it in over 10 years. So that's some really serious security, okay? But with what is it? What did they say? With responsibility, with freedom comes responsibility. So you got to protect your key. Possession is not 9/10 of the law. Possession is 10/10 of the law. Okay, you've got to guard your keys, and ultimately, you shouldn't trust them to anyone, right? As Bitcoin people say, not your keys, not your coin. If you have your private key and you store it at Coinbase, or you have your private key and you store it, at Schwab or whatever, or you have your private key and you buy an ETF fund and you trust the ETF fund is going to take good care of your private keys, that might be reasonable when you're first starting off. But you should always be careful about it, because take a look at what happened to the people in Canada over the summer. I mean, there were like millions of regular, ordinary Canadian citizens who had their bank accounts frozen just because, boom, they didn't like the truckers, or they liked the truckers, or somebody didn't like the truckers. I don't remember exactly what it was, but the government decided, hey, you're donating $50 to these truckers. We don't like that. We're freezing your bank account. Boom. So, not your keys, not your coin. if you entrust your keys to somebody else, you really don't own it. And then the other thing is that Bitcoin is public. Anyone can see it. There's no insider information. Every single trade is published to the blockchain, so it's literally an open market. Last thing I'll say, and then I just got two more. Last thing I'll say is price. We talked about price. In the long run, when all the adoption is kicked in, the price of Bitcoin will be equal to, the equilibrium price of Bitcoin will be equal to the amount of energy, the cost of the energy that's been used to mine it. And so here you can see in this chart a graph of the so-called hash rate of Bitcoin. That's the amount of electricity that's been used throughout the world to mine Bitcoin. You can see, for example, it took a sharp dip here, and that was when China banned all the Bitcoin miners. But then it came right back up again. So ultimately, the price of Bitcoin will ultimately wind up resolving to the cost of the electricity that's been used to make it. But we should also realize that we're still in the early days. So, as the adoption increases, the price discovery also will react. And many people think that the price of Bitcoin will go much, much higher as the adoption increases. And so many people never sell it. They just hold it forever. You never actually own Bitcoin. You just take care of it for the next generation. It's like buying land in Manhattan in the 1800s, many people think. So when you're just getting started, I think that the ETF, like an ETF to buy Bitcoin, that'll get approved. Canada and Europe already have them. The SEC is sort of lagging on approval for that, but we expect it'll be coming. When it does come, I think it'll make sense. You can buy Bitcoin, you can have someone else custody it for you. You don't have to worry about all the technology, and you can just trust the ETF to secure it for you. However, I would recommend that whatever ETF you use, that they do what they call is they guarantee the reserves. They should publish their Bitcoin wallet address so that you can look on the Bitcoin blockchain and you can see for yourself how much Bitcoin they actually have. This is a problem with gold, by the way, because how much gold is there really? you can say, oh, well, this dollar is backed by gold, and you're like, okay, well, is it really backed by gold? Where is this gold? Has any, some people would argue if you go to New York and you go down 50 stories in Manhattan, there's JP Morgan on one side of the street and there's the Federal Reserve on the other side of the street. They both just happen to have elevators 51 stories below the ground in Manhattan. So if you want to do a gold audit, well, you might be able to just shift a little gold over here for the Federal Reserve. You might just be able to shift a little gold over there for JP Morgan. I'm not saying they're doing that, but how do you really know they have that much gold? Well, with Bitcoin, you do know because it's on the blockchain and you can absolutely prove it. So that's one thing. The other thing is don't invest in futures. Don't invest in derivatives on Bitcoin because that is basically creating paper Bitcoin. It's because it settles in cash. It doesn't settle in Bitcoin. If I'm a farmer and I'm going to sell you the right to my corn 6 months from now and you buy it and then I deliver my corn, that's okay because we're actually talking about delivering corn. But if instead I sell a bunch of futures contracts for corn, and if the price of corn goes through the roof, I don't actually have to take delivery of corn. I just have to sell it for dollars. Well, that's not really corn. That's not really futures trading. That's just financial engineering. That's just derivatives trading. It's paper Bitcoin. It's inflating the supply for people who don't understand that it's not really coin underneath. Most important thing is that we are talking about savings money, and savings money requires long-term thinking. I would argue 4 years is the absolute minimum holding time for Bitcoin. No one who has held Bitcoin for 4 years has ever lost. There have been plenty of people who have lost when they sell within 6 months. So this happens. The short run is very volatile. It goes up and it goes down by big numbers. So you can't get spooked and get shaken out of the market. Don't buy any Bitcoin if you can't hold it for at least 4 years. And as I mentioned, many people hold it for generations. To wrap it up, I've said a lot that there's some resources for further learning. I would highly recommend you spend 15 minutes and you watch this video right here, this YouTube video. It was made by Princeton, and you'll understand the technology really well. You'll know what a hash function is. You'll know what a blockchain is. You'll know what mining is, and you'll know how separate distributed blockchains can coordinate together for a single version of the truth. So that one's highly recommended. The other one that's highly recommended is this book right here, The Bitcoin Standard. It's pretty much the Bible of Bitcoin. It's about 200 pages, very easy to read. If you read this one book, you'll basically know everything that I've talked about here today. So I appreciate your time, and I'll wrap it up there. Thank you very much.
The question, though, is related to inflation. Why not just invest for a smaller investor in inflation hedged investments rather than risk the volatility that's going on now until the coin stabilizes? Because we don't know where it's going to stabilize. You mentioned the swing from almost 70 down to almost 20. That's a big inflation swing if you didn't have a choice, especially if state issues or otherwise, to keep the coin for an indefinite period of time.
Okay, so first off, again, I'm not saying financial advice or whatever, but what I would say, it depends upon your where you are in your cycle of life and where it is in terms of your risk allocation, right? Like many investment people would argue in favor of a diversified portfolio, or you have some equities, you have some bonds, you have some high yield, you have some risky small cap, and you have some large cap, and you sort of diversify in order to get a balance the risk reward associated with a portfolio. And typically younger people can be a little bit more aggressive in their portfolio allocation than older people who need to be more conservative. So the many people who invest in Bitcoin, do so with this notion of getting an asymmetric return, right? So even if you just put like 5% of your portfolio in Bitcoin, if it does what many people think it will do, that can have an outsized impact on the overall growth of the portfolio, and yet it's still a relatively small share from the downside point of view. And that's the way I think people should think about it right now. But if I was a young person, I would definitely be stacking, they call it stacking sats. I would be stacking sats like crazy if I was a young person. Because as I said, anyone who's held Bitcoin for 4 years, no matter, I mean, look at Amazon. Here's the other example I always say, look at Amazon. Do you know that there are only four people who were on the Amazon IPO and never sold? Only four. Jeff Bezos is one of them. You know that Amazon, you know, they tumbled. They were going through the roof and then they dropped 80%. There were times when Amazon was really, really low. So, you know, low time preference, right? You know, you have to think long term. And that's what that other book, The Tao of Capital, teaches. It's like you really have to have you have to have a long time preference. And if you don't have a long time preference, you should definitely not buy Bitcoin.
Excuse me. How does blockchain work with Bitcoin to make it more secure and trusted for use?
So a blockchain is nothing more than a sequence of blocks, right? So what is a block? A block is a set of transactions, like I want to give Bitcoin to you. That's a transaction, right? That's a line item, a transaction. You want to give Bitcoin to Sally. Well, that's another transaction. So what happens is they group up all these transactions until they fill up a block, and then they send it to the cloud, let's say, and then miners package it up into a block and they try to solve a puzzle, a math puzzle, before to win the right for everyone else to agree to them. And so the reason why the blockchain it promotes security is twofold. Number one, you can't corrupt it because because you can't rewrite history. What happens is the result of performing this mining function is you get a big long string that is the answer. And that answer, it's called a hash. And if you watch that Princeton video, which is 15 minutes long, you will totally understand this. That hash is stored in the block. And then the next block gets created, and that next block has the hash in it as well. So if anyone wants to change a block from 3 weeks ago, they have to mine that block and the next block and the next block and the next block. It's a chain, right? So the cost of rewriting history increases exponentially the further back you go, right? And so why would I spend, you know, hundreds and thousands and millions of dollars to try to rewrite history by remining all of these blocks when I could use that energy to mine new blocks and get paid for it? And the blockchain is visible to everyone. So if anyone tried to muck around with the blockchain, everyone will be able to see it and they could tell right away.
Yeah, thanks again. Great presentation. Quick question. The question I had is around the number of Bitcoins that will be physically available. I think you mentioned a number like about 20 million or 2 million, something, some big number out there. Now, if any economy, let's say the US economy today is about 22, 23 trillion dollars. In another 10 years, it might be 40 trillion and so on and so forth. And in a normal world, we would print currency to, you know, enable the functioning of the economy. Now, if Bitcoin was limited in its availability, how would it support a growing world economy in a theoretical sense if everybody, adopted Bitcoin?
Yeah, that's a really good question. So the first thing to recognize is, let's just get the numbers straight. So there's a maximum of 21 million Bitcoins that'll ever be mined. And each individual Bitcoin can be divided into 100 million pieces. That's called a Satoshi. I call them Bitcoin pennies, basically. There's 100 pennies to a dollar. So basically that's 21 quadrillion individual pieces, okay? Not 21 million, 21 quadrillion individual pieces. That's a lot of divisibility, okay? And so right now, Bitcoin is divisible to 8 decimal places. That's what gives you the resolution. And if it turned out that 21 quadrillion, individual units was not enough, then you could, further divide it into smaller bits from there. Last thing, there's one other thing worth mentioning. This guy, Jeff Booth, I put him on the thought leader slide at the very end. Jeff Booth is one of these guys who asked the provocative question, why is it that we need inflation? Why do prices have to go up? I mean, after all, the cost of a color television went down. We are having all this technology that's making us more productive. Why is it some immutable law of nature that prices must always go up? You know, well, the reason why is because of fiat, because we've been living in a fiat world where the government is taxing people. That's basically it. You go to the pump and you pay gas at the pump. You don't know how much tax is in that pump, in that price per gallon, but trust me, there's a lot of tax in that gallon of gas or whatever. Same thing with inflation. It's taxing the people. They don't even know it, right? So there's no reason that we really have to have an inflationary economy. In fact, you could argue that it should be a deflationary economy, because why shouldn't the advances in technology and the increased productivity that we all get from progress make our standard of living higher and make our money worth more in the future, right?
But Jason, under that theory, why would the value of a Bitcoin ever go up?
Well, the value of a Bitcoin would go up in the short run. It'll go up as adoption increases because people will be fighting for a larger share of a scarce resource. But once it's been fully adopted, then the value of the currency, the value of a Bitcoin, will increase directly in proportion to increases in productivity of the economy as a whole.
Okay, this has been an amazing chat. We are definitely at our time, so I think we're going to wrap it up. And Jason, thank you so much for giving this talk today. It was so interesting.
Thank you, guys. I really enjoyed it. Thank you.